everyone. My name is Kay Osborne, and I'm your online instructor for Accounting 209. I'm going to apologize for the recordings this week. I'm learning to use the new recording studio at Drury, and they may not be very good, but I promise they'll get better as the semester goes on. And I do want to record information for you, and hopefully it helps you to learn the information. Sometimes accounting is a little hard to keep track of online, so I'm going to do my best to do these weekly videos for you and try to help walk you through the information. You're going to have several steps. First of all, you need to sign on to Moodle, and through Moodle you need to click on McGraw-Hill and sign into the classroom. On McGraw-Hill, there you will have both a reading and review, homework, and a quiz. I'll give you a little more information on that as the week goes on. But today I want you to learn to sign on to Moodle, sign on through to McGraw-Hill, and email me and tell me that you've got that far. And then I'm going to talk through the first chapter. There will be 3 separate videos, so they won't be very long. And hopefully they're 10 minutes or so each. And hopefully these help you understand the reading, homework, and quizzes that you're going to do. So to start out with, many of you who are not accounting majors are going to ask, why do I have to take accounting? Well, I feel like accounting is the foundation for all business practices. Many managers have to deal with daily accounting, the importance of accounting, and it's important that everyone understand financial statements, whether you're an internal user or external user of this information. So there are 3 steps to accounting. One is to identify the transaction, the second is to record it, and the third is to communicate it or to prepare those financial statements that you're going to learn about during this class. I just talked about, I've got to fix my PowerPoints before next week, but I'll just move around and kind of get in the middle of them. You have users of financial statements. Accounting is called the language of business because it tells other people how your organization is doing financially. Internal users are, of course, those people who work inside your company and need to know the information about the accounting and accounting practices of your organization. That might be your officers, managers, auditors, staff, budgeting people, controllers, floor managers, store managers. But the external users are the people who really look for that good information that they need to know about your company. Those are lenders. Well, why would lenders want to know about your company? Well, because they want to know if you're a good risk to loan money to. Shareholders, the people who own stock in your company, they want to know if they want to buy into your company or not. The government, well, of course, the government wants to know about your company because they want you to pay the appropriate amount of taxes. Consumer groups, external auditors, customers. Well, why would a customer care about your financials? Well, if I'm going to buy a car, I want to make sure that the company's solid because they're going to offer a warranty, and I'm going to want to make sure they're able to cover that warranty they have. I also want to make sure companies I buy from are responsible socially. So there's a lot of people who care about your business, who want to know about your business, and who have an expectation that your financial statements are honest and correct. Some of you are considering majoring in accounting. Others of you are management or marketing. I'm going to scoot over this way now so you can see all the opportunities in accounting. Accounting information affects every area of our life. As employees, we earn money, we expect our employer to pay taxes, we invest in banks, we put our money there, we allow them to loan our money to other people. And there's just a whole bunch of jobs in our society that are available that require you have at least some basic knowledge of accounting. There's some need to know files through here. You can work on those on your own. They're just going to help you answer questions both in the homework and then in the quiz. So you want to work through those. I don't work through those with you. The answers are given to you on the next page. So you can work through those on your own. Ethics is absolutely important in accounting. It's to provide the most useful information for decisions. And for us to be able to use the information, that we must be able to trust us. Ethics are beliefs that distinguish right from wrong. They're accepted standards of good and bad behavior. So people who work in accounting have to identify ethical concerns, analyze all their options, and make ethical decisions. We'll come back later and talk about ethics in a future chapter, and then we'll talk about human error versus human dishonesty. The fraud triangle, you're going to talk about this all the way through your business career, your business college career. In order for dishonesty or fraud to happen, these three things have to be available. There has to be an opportunity. You don't have good internal controls in place, or the company doesn't have internal controls in place. Money is not kept deposited on a regular basis. And then there's usually one or two of the other. One is rationalization, and that's when a person just doesn't see it as dishonest, or they feel like they work really hard for their money and they don't get paid enough, or they feel like their boss makes a lot more money than they do and they deserve more. So they rationalize it with themselves that it's okay to take this money. And the other is financial pressure. Sometimes people just get in such a tough place financially that they feel like it's okay to take money, or they just start taking a little money and that builds and builds and they take more. So the fraud triangle is an important reason why people take money, commit fraud from another company. And what you have to do is make sure that these three opportunities don't exist in order for your company to have good internal controls and money not be taken from your company. So we're going to talk about some of the rules of accounting practice. I told you that people want to be able to trust financial statements. They want to have a good understanding that when they look at this information that companies put out in financial statements, that it's relevant, reliable, and comparable. So relevant means that it matters. It's important enough that it's included in the financial statements. These are called generally accepted accounting principles, or GAAP. All the way through class, I probably will be talking about GAAP, or generally accepted accounting principles. You want to be sure that the information is reliable, that those numbers are correct, that what you see is what they mean, and you want to make sure it's comparable, both comparable to other years for this company and also comparable to other companies in the same industry. For example, if I wanted to buy stock in either Amazon or Walmart, although they're not the same company, they do the same thing. So I would want to look at their financial statements, be able to compare them side by side, know what the likenesses were and the differences were, to make a decision about buying stock. We also have principles and assumptions. We have general basic principles, and those principles are measurement, full disclosure, revenue recognition, and expense recognition. Measurement just means that we're able to we measure everything at the cost at which it was purchased. So if you buy a piece of land for $50,000, although you may have got it at a great bargain and it's really worth $80,000, you record the cost of that land at $50,000. Full disclosure just says that anything that the users of the financial statement need to know has been disclosed to them. So, for example, if there's potential for a lawsuit next year, that would be disclosed in the financial statement. That way, someone considering buying stock would know that before they purchase the stock. Revenue recognition says that a company recognizes revenue when it is earned, not necessarily when the cash is received. Later in this book, we'll discuss cash versus accrual. And expense recognition says that we recognize the expenses that are incurred when the revenue occurred. So it's a matching principle. Our assumptions are that this business is a going concern. It's going to continue on, that it's in a monetary unit, that we don't necessarily barter, although there is sometimes something other than cash given in exchange, that financial statements are expressed in monetary units, that it's for a specific amount of time, and that it's a business entity, and that is separate from the personal finances of the owner or stockholders. And constraints are materiality and benefits equal cost. Materiality just means that it has to be material enough to matter on the financial statements, and benefits cost just says that the cost of doing the audit or the investigation have to outweigh the benefit of it. So those are the principles, assumptions, constraints. You need to understand the generalness of those and what they mean, and those will come up in your quizzes and in your homework. I've already gone through these, so we will just keep on going. Most of you have already had you've already had business foundations, and you've discussed the difference between proprietorship, partnership, or corporation. The main differences are how the business is taxed, the liability, and the limited life or unlimited life of the business. Read back through these again. Make sure you understand the difference between a sole proprietorship, a partnership, or a corporation. Sole proprietorship is just a single person. Partnership is 2 or more people. And a corporation is an entity that's separate from the owner and can have 1 or more owners. Sarbanes-Oxley is a law that was passed to curb financial abuses at companies that issue stock to the public. This law was passed, about 15 years ago. SOX will come up over and over again in your business classes, and it's just a way to keep companies honest and to make sure that there's oversight, that there's transparency, accountability, and truthfulness in reporting. Dodd-Frank came along when there was Wall Street reform about 8 years ago. It's a Consumer Protection Act, and it's a law that was designed to promote accountability and transparency in the financial system, put an end to the notion of too big to fail, protect the taxpayer by ending bailouts, and protect consumers from abusive financial services. So this was about the time that big banks were failing, and the government was bailing them out. So the Dodd-Frank Act came into effect at that time. We've already looked at these. It's another need to know. And I'm going to end there for the first video. I promise these will get more professional, but for this week, this is the best you get. That's the first part of Chapter 1, and I will be coming back to talk to you again about the rest of Chapter 1 in videos 2 and 3. Thank you, and I hope you have a good week.